Would you take $3 million right now, or one penny that doubles every day for 31 days? Most people grab the $3 million, but that tiny penny quietly grows and then explodes past $10 million by day 31. That's compounding. Boring in the beginning, explosive in the end. And here's the crazy part. The same math has been used by real traders. Mark Minervini, for example, compounded his wealth by over 33,000% in just 5 years. With the right risk and position sizing, even tiny edges can stack up to triple-digit returns. As Mark Minervini often says in his books, if you torture numbers long enough, they'll tell you whatever you want to hear. So let's torture the numbers, and we'll show you how this math might work. So before jumping into the math of triple-digit returns, let's first look at the double-digit returns. In every market around the world, there are about 252 trading days. Now imagine these dots on your screen. Some green, some red. Each one represents the trades you take during the year. Let's say you take 124 trades. That's one trade every alternate day. The green dots are your winning trades, where you make an average of 12.5%. The red dots are your losing trades, where you lose an average of 6.25%. That's basically a 1-to-2 risk-to-reward ratio. And to keep things simple, let's assume you win half and lose half. So out of 124 trades, you get 62 wins and 62 losses. Here's the important part. You're not risking your whole portfolio on every trade. Each time, you only take a 25% position. So if you have $100, you're exposing $25 per trade, while $75 stays in cash. At any point, you only have one trade running, either a win or a loss. Now, the big question is, after a whole year of trading like this, 124 trades, 50-50 win rate, 1-to-2 risk reward, and only 25% exposure, what's your total return at the portfolio level? Your $100, your full capital, grows to about $196.90. That's a 96.9% return. And remember, your exposure on each trade was only 25% of your capital, which means the whole time you were still keeping 75% in cash safely with you, while your portfolio was compounding as if the full $100 was at work. This is the real power of risk and reward math. You didn't need to win more often than you lost. You just needed the right balance of risk and position sizing. Now let's change the scenario. Earlier, you were only exposing 25% of your portfolio at a time. That meant $25 was working, while $75 sat in cash. But what if you decide to use your full portfolio? This time, you still keep the position size at 25%. But instead of just one position, you take 4 positions at the same time. So that's 25 plus 25 plus 25 plus 25 equals your entire $100 fully exposed. Each position still works exactly the same. Wins give you 12.5% on that $25. Losses take away 6.25% on that $25. And the win-loss ratio is still 50-50. Here's what changes. In scenario 1, with just one position at a time, it took 124 trades across the year to complete the cycle. But now, because you're running 4 positions at once, the same cycle can be done in about 31 trading days. In other words, you've sped up the process by 4x. So what happens to the return? Surprisingly, it's exactly the same. Your $100 still grows to about $196.90. That's a 96.9% return. So what's the real difference? Case 1, you keep 75% in cash, take one position at a time, and grow your portfolio more safely, but slower. Case 2, you go all in with 100% exposure, run 4 positions at once, and reach the same return faster, but with higher portfolio level risk. That's actually food for thought on how you play these approaches in bull markets versus bear markets, and in trending and non-trending cycles. This is why understanding risk, exposure, and position sizing is just as important as your win rate. The math of returns doesn't change, but the way you structure your trades changes the speed and the risk profile of your journey. Now let's come to the thing that you've all been waiting for, the math of the triple-digit return. Now let's take this one step further. In a year, there are about 253 trading days. Imagine this. Out of the 253 trading days, on 216 days, you don't really make any money. You just break even. But on the remaining 37 days, you manage to capture just a tiny edge. Let's say 2% return at the portfolio level. Here's where it gets interesting. On those 37 days, you take your capital, apply 2%, then the next day you apply 2% again. And again, that's compounding. So instead of thinking 2% is small, you're actually compounding your capital by 2% 37 times in a year. And what does that look like? You start with $100. Just like before, you might keep $75 in cash and only deploy $25 at a time. But here's the key. On those special days, you're generating about 2% on your portfolio as a whole, not just on the $25 position. Now, pay attention here. Please pay attention. This is a portfolio level return, which makes all the difference. So whatever your end capital is, you apply 2% again and again, compounding it over 37 days. And after 37 compounding days, that $100 grows to about $208. That's a 108% return, more than doubling your money, even though you only made real progress on 37 days out of 253. This shows you the real secret. You don't need to win every day. You don't even need to win most days. All it takes is catching a small edge, just 2%, and letting compounding do the heavy lifting. That's how traders can achieve 3-digit returns. Now, so far, we've been talking about generating 2% at the portfolio level. Please pay attention. It's at the portfolio level. But here's a natural question. If only $25 is deployed in the market, how much return do you need on that $25 position to achieve a 2% gain on the full $100 portfolio? Think of it this way. A 2% return on the $100 portfolio equals $2. Since only $25 is at work, that $25 needs to generate $2 by itself. So $2 on $25 equals an 8% return. So yes, an 8% gain on the position is equivalent to a 2% gain on the portfolio. But pay attention. This logic works only for a single trade at a time. We're not talking about compounding here. It's just the one-to-one relationship between a position and the whole portfolio. So the lesson is simple. 8% on a $25 position equals 2% on the $100 portfolio in a single instance. Always be clear whether you're calculating at the position level or the portfolio level. The difference changes everything in trading math. And then you compound 2% again and again over 37 days, and that's how you get to the triple-digit returns. So here's the beauty of this math. Even if you're only risking 25%, the other 75% of your capital doesn't have to sit idle. You could put it into safe returns, ETFs, real estate, debt funds, or even just plain bank interest. But this is just the base framework. The numbers can be tortured in 1,000 different ways, so you should be very careful as the real-life outcome might greatly differ from the stories the numbers initially told you. Like Minervini said, if you torture the numbers long enough, they'll tell you anything you want. And every time, they reveal a new story. For traders, the real adventure, the question, is this. How do you actually accumulate those kinds of high probability winning positions in real trading? And that's what the hunt should be about. Now we'll throw it back to you. How would you do it? Drop your thoughts in the comments because we'd love to see the different ways you'd twist this math.